Mr. Vice Chairman, thank you so much for joining Bloomberg this morning.
Thanks to you, Tom.
I want to bring up a chart, which I think goes back. We like to do this with anybody of your stature. Can we go back to 1969 in a chart that Mrs. Fischer made in your thesis at MIT? I have no idea what this chart is. It's from your original thesis of the XYZ space on contingent commodities. Whatever that chart is, it's in the textbooks. It's in your classic textbook, Dornbush Fischer Stars. Is the economics of today in the textbook or in that thesis of 1969?
Well, the basic economics hasn't changed that much. The sort of understanding of what the fundamental forces in the macroeconomy are hasn't changed that much, but what those forces are have changed a lot over time, and we're operating in a much more globally integrated, not fully integrated by any means, economy. By the way, I don't recall doing that chart, but...
you say in your notes that Mrs. Fischer did that chart for you a few years ago.
I'd be surprised, but if that's what it is.
What is the next chairman and the committee as a whole, the Federal Open Market Committee, what type of economics do they have to do? May I suggest that it needs to be a more malleable economics?
Yes, it's not as simple as it used to be, and you've got to take more forces and more changes into account, with us being very close to a globally integrated economy.
Our Michael McKee was talking about you teaching at MIT with Chairman Bernanke as a student, with President Draghi as a student as well. How would you teach the PhDs today? Would you teach them differently than you taught Bernanke and Draghi?
Well, there's a saying that science progresses funeral by funeral. So I think I'd be teaching more or less the same things, and the next generation would have something more advanced, more different than I would have had.
Let me dive into our economics today. You spoke to the Economic Club of New York in October of a bit ago, and it was about ultra-accommodative. I'm going to say that Stanley Fischer gave us this phrase, ultra-accommodative. Bring up the chart in New York, if you would. And this is a terrific chart of the inflation-adjusted Fed funds target rate, and we still haven't gotten back to the zero level. The yellow circle's your Economic Club of New York speech. Are you happy with the pace that we're on to get back to a normal Fed?
Well, I'd rather that the real interest rate became positive, which we expect to happen sometime in mid-2018. So the pace is okay. It's not terrific, but this is a very complex issue, which is related to the decline in productivity growth, among other things, and it's related also to decisions that the government would make. The real interest rate rose quite a bit when it was expected that there'd be a big fiscal stimulus.
Yes.
And it went down afterwards when the expectation of the stimulus was reduced.
The expectation is an important word across all of Stanley Fischer economics. Good morning to Professor Lucas at Chicago, and of course you taught at Chicago years ago. Are we expecting too much in our guesstimates of inflation? Do we have too much of a belief that we will have a higher inflation?
Well, I still believe we will have higher inflation. There are basic mechanisms, and the basic mechanism here is where unemployment is declining all the time. Wages will start going up at some stage. And the experience many of us have, including myself, is you have to wait a long time, usually longer than you expected to wait for something to happen. But then if it's a very basic force, namely increase in employment, increase in wages, it'll show up. And once it shows up, we'll say, oh, yeah, that's what we expected.
I spoke to our Bloomberg economics team about what to speak to Vice Chairman Fischer about, and there's so much uncertainty about the future of this important global institution, the Federal Reserve System. Let's start with the idea of a low-rate psychology. The joke is low-rate Janet, with great respect to the chair. The reality is we have low-rate Donald. We have a president who seems to be wired for the comfort of low rates. Is that a mistake?
Well, there are reasons to want lower rates, especially when growth is so slow and investment has been smaller than expected. for quite some time. So low rates are to encourage investment. They are to encourage growth. They have been less successful in that than we expected, but they've been very successful in encouraging employment. And the miracle of this recovery is that it did not generate, that the crisis did not generate long-term massive unemployment. We're basically back to something close to full employment.
I would ask your mentor, Paul Samuelson, who should be the next Fed chair. I won't do that with you about the politics of this person or that person. But it's obviously a critical appointment to have a new chairman. Explain to the American public how the new chairman or chair will be different from what we've seen in previous leaders of our Fed.
Oh, this is a choice clearly of the president and the administration, and that decision is up to them. There are candidates whose names are in the newspapers. You
Yes.
don't know how important they are. And it's really not appropriate for me to get into deciding who's going to be the next chairman.
I would suggest that's probably true. Maybe I'd disagree. Mayor Brendan Murray would disagree with you and want to know name, rank, and serial number. But the basic idea here of if we have the turmoil we have in America and the economic uncertainty in our theories, will that migrate us towards a more rule-based system and away from discretion over the coming years?
Oh, I think the attraction of a rule-based system is very large. I think that in practice you'd find yourself having to define all the time when it's appropriate to diverge from the rule, because the rules do not anticipate the many strange things that can happen in an economy, even such things as 3 hurricanes in a row, which is not a huge surprise, but it happened and it changes policy, and there are many other things that will change policy. So I think rules are a good guideline to the basic path you're taking, where you're trying to go. But I wouldn't run monetary policy on the basis of rules where you strictly go down, look at this equation, say that's it, and let's get rid of the central bank.
I believe you were in Zambia years ago, and your first book was Maynard Keynes of 1936. Do we need a Fed chair like Chair Yellen, who has read Maynard Keynes 1936? I believe we have a number of candidates that probably haven't even gone through those few key chapters which are considered the canon today.
Oh, they should read it, and they should read the whole book, because at the end of the general theory, Keynes has a chapter on what happens when the interest rate gets too low. And it's worth reading even today. What's in there.
Can we have a new setup with someone like William Miller of Past Times and Places, a non-monetary Fed chair who has a vice chair of your capabilities or Chair Yellen's capabilities? Or do we need to have that monetary expertise for crisis and shock as chairman?
Well, I've found in my terms in one place as governor and in others as vice chair, that having the basic economic theoretical knowledge and experience increases your self-confidence about what you're doing. Is it essential? I doubt it. There are very smart people who could figure this out in many ways. But is it helpful? Yes, very much so.
What is it like in a 4 standard deviation shock? You enjoyed 1998, you enjoyed the financial crisis, and you've enjoyed the struggles forward here. For the next chairman, whether it's Kevin Warsh or it's again Chair Yellen to be reappointed, many people talking about that. What is the difference of people like you in a 4 standard deviation shock of the moment or set of shocks versus a normal day at the Eccles building?
Well, the difference is there something that you ought to do, or should you let the markets take care of it? And if you decide to leave it to the markets or to wait a week and see what it really means, those are things which depend a great deal on the experience you have, on your understanding of how the markets work, and that you get over the years. And I've sort of to take a simple example, the initial reaction of people who haven't thought is something bad happens, you close the markets. That's terrible.
In your final thoughts in London, in your speech of the other day, a wonderful speech sort of on the tapestry and history of the Bank of England, you talked about never say never events. What kind of chairman do we need to be steeled and ready for never say never events?
You simply need someone who has the flexibility of mind to see that he or she needs to take a different route at a particular moment in time or over the next year or two, and someone who has also the capacity to lead a very large, very complex committee, the Open Market Committee, to agree with his or her thoughts.
It seems like you just described John Taylor, but I won't put you in the trap of talking about Professor Taylor of Stanford or any of the other good candidates that we have involved here. I think the arch question, and particularly for the Bloomberg world, is Peter Orszag would say out of LSE that we have glide paths, that we have paths of stability as we move forward, and then we have these exogenous shocks and we have jump conditions. Do you have confidence that the two strategies of rate moves and balance sheet can be done over smooth glide paths that can be controlled by the institutional forces we have, or do we need to be steeled for jump conditions to come?
Well, we always need to be steeled for the possibility that we need to change course drastically. In October 2008, the Fed changed course drastically. That was obviously the thing to do after the financial crisis began to develop. So you have to watch and wait and hope you can stay on the smooth path, but never believe yourself that you can stay on those paths forever. You can't.
It is unimaginable to think of you retired. Do we get another edition of Dornbush Fischer Stars?
I don't know at this stage.